Hi everybody, it's Vitaly, and we're back for another episode covering a couple more stocks. We just dropped another video, and it's with Mark and Arcimoto and showing the new factory tour and Arcimoto's Fall FUV Rally. So here it is right here. I'm going to link it up here and in the description, so check that out. I do have a bit of news that we're going to be having an interview with the CEO of Neovolta. So big stuff coming. This is a great little company with a small market cap that you guys are going to really enjoy. They sell battery tech, just like Tesla Powerwalls. That's what they're doing. There's huge upside here for us. And we're going to talk to Brent Wilson in a couple of weeks. We have an interview scheduled, so we'll update you as we get more information. And the last bit of news before we start, please just like and subscribe. I included our Twitter and email, so contact us and tell us what you want to see. If there's any stocks in particular you love and you want to follow, let us know. It's not one I really talked about before, but I am an investor in LMND. And it's one of those growth stories of insurtech that can totally blow up or can totally fail. I'm on the side that this is sort of like the future of insurance because I even bought some insurance from LMND for pet insurance. I haven't switched everything. It's not like I'm doing life insurance and everything yet with them, but I just started to test to see if this is something legitimate that I would use. And I am using it with pet insurance, and it's kind of good. So it's an insurtech play. It's a small market cap. Here it is at currently 4.19 billion. Short interest is huge at 30%, so people really expect us to do bad, and short term it might, and it has been obviously. So the shorts are sort of correct in the short term. 52-week range, it went as high as 190, and now it's sitting at the bottom of the range. That's why I'm picking it up again. This is probably a good time to start looking at LMND, because remember, the bigger insurance guys are worth tens of billions, and this is worth less than $5 billion bucks right now at $65. This is their website. And you guys can go take a look further into it, but they're a highly rated company. And just to show you how highly rated they are, LMND Homeowners Insurance Review by US News. They are rated Best Homeowners Insurance of 2021. The reason I am sort of bullish on this company is because they're revving up to enter the car insurance market. So if you take a look at what they're in now, they're in pet insurance, renter's insurance, I think they're in home insurance, life insurance they began as well, but the big market is car insurance. The article says, the U.S. car insurance industry is estimated to be about $300 billion, 70 times the size of both the renters and the pet insurance markets. LMND said a large majority of its existing customers are car owners, and they already spend about $1 billion on car insurance each year. The big bull thesis of this is that car insurance is not a small business. It's bigger, 70 times the size of their renters and their pet insurance. So I would say if LMND is able to capture some of that, then we're talking about a much bigger company. So the $5 billion valuation could explode. So even if it's back at the $20 billion, well, now you have a 3-4x, right? So let's go to the chart of LMND. This is why I think it's a good price to buy. I feel like the main trend, even though it went above it in this massive rally it had, is between these two purple lines. And it looks like it's holding it fairly well right now. We'll have to keep a close eye to see if it breaks down. But so if it is trading between these two ranges, and this is sort of like the center line where the price wants to hang out in the middle, we're talking about the price should be roughly at $100 at some point. Not saying in the next 3 months or 6 months, but at some point it's going to be at $100. And if it's going to go above this, it's going to go back to around 170, 180, 200, somewhere in that range. So we're talking about a $65 stock going back to 100, represents almost a double, not exactly. And if it's going to around 200, a little bit over a triple, right? So we're actually making a good return on this company. So even if you didn't want to keep it, this seems like a reasonable swing trade in terms of like holding things for a year or two. So I'm not swing trading this for the next week, for the next month, for the next quarterly. I'm buying as many shares as I can at $60 at around $200, maybe 180 or so. I'm going to start to sell half of my position. The reason I'm selling half is because then it's paid for more than my shares. It's gone over 3x. It's paid for more than my shares. At 180, it's roughly a 3x. And I've gotten way more than I put into it. And I get to keep half my shares thanks to the market, right? So then the other half of my shares get to ride. This is why it's sort of important. I go back to like when I do covered calls and cash secured puts, I always buy more shares than I actually want. So if I wanted 1,000 shares, I would get 2,000 shares. If I wanted 100 shares, I would get 200 shares. I know that sounds tough, but this is why you pick your winners. LMND, I think, is one of my winners at this price because even if it drops to $50, I consider it a buying opportunity. While some people might say the sky is falling, I consider it like they have growth catalysts of car insurance and reaching out to a whole new set of the audience of millennials who are buying insurance, who haven't bought it yet. Because honestly, how many 20 somethings have looked into insurance? Not many. So as these people mature and grow, and there's a digital platform for them to buy, they're going to do that instead of call State Farm. Like imagine a 20 something calling State Farm. Like they're going to do it if they have to, but if they have another option, they probably won't. So that's my bull thesis, that this company is in the right space. It's hitting the right targets of young people, basically 20 and 30 something. And they have car insurance coming. So they have this sort of these catalysts that are mounting on top of each other, and plus upselling to their current customers all these types of products. We are in a downtrend here. Do want to point that out. So we are still have not broken out. So this is going to be interesting what happens up until the end of the year. And we're going to see if we can break out if we hold this trend line. And if we do, we're sort of off to the races again, because maybe they've come out with their positive catalysts, like releasing car insurance. If they haven't released the car insurance product, we might break down. And we might go all the way to March of 2022, somewhere in that neighborhood, until some positive catalyst can propel us up. All right, so that's about it. We'll see what happens with this trend line. If it holds it, if we can break out, then we're off to the races. If not, $50 incoming, get ready. We've covered SoFi before. That's the next stock up. And it's had a bit of a run because of a bunch of positive news. And some analysts have come out raising their price targets. Current market valuation was $16 billion. I'll include a link. We actually covered it when it was closer to 10. So we were buying it at the $13, $14, $15 range. Now it's at around $20. I'm not exactly rushing in because the upside short term is limited. Long term, it's still probably a good price to just DCA if you're doing a long-term purchase. But I've bought most of my shares already at 15, so I'm not rushing in at 20. This is why I think it's been pumping, because a couple of analysts have upgraded it. And also the bank charter supposedly is coming anytime soon. One analyst said $28. Another one from Morgan Stanley says $25. SoFi's customers have been ramping their cross-buy and now make up 24% of SoFi's total product. Since they have a large offering, they don't need to go reach out and try to find new customers all the time. They can actually sell it internally and therefore increase their profits, increase their margins. And after more than doubling the customer base over the past year from 1.2 million to 2.6 million over the next 2 years, Graseck expects it to double again and reach 5.3 million customers. If this analysis is correct, we already doubled our customers, and we're going to double again our customers to 5.3 million. Adding to the bull case, the next 6 months could see two meaningful catalysts drive faster revenue growth and positive revisions to management guidance. First off, a surge in student loan volumes, a 70% increase according to Graseck, should follow the expiration of the government student loan deferment program. So remember, right now the government is sort of deferring these loans. So SoFi is not making as much money. That's why they tanked in Q2. That's why we had an opportunity to buy it at $13. But as soon as that program is over, the deferments are over, and SoFi can resume its sort of standard loan business, then this analyst expects a 70% increase. Secondly, there's the prospective approval of SoFi's bank charter. This alone could boost total revenue by 10%. Accordingly, Graseck initiates coverage of SoFi with an overweight buy rating of $25 price target. So remember, though, the price targets, though, are for the year. So if we're talking about SoFi now at $19.38, they're not saying next month, next week. They're saying within a year, $25 price target. That's why you guys should have been buying it at 15 when we were talking about it. And now, if you haven't got your full stake, it's still worth it. Is it as nice of a deal? I don't know. That's really up to you to decide. This is the analyst, by the way, Betsy Graseck. She has seemingly good ratings on tip ranks. Average return, though, is 10%. Not too impressive for the returns. The chart of SoFi we've looked at many times already, and I'll like I said, I'll include a link above and below for our coverage of SoFi and why we were so bullish on it. We still have a problem. We're in a downtrend. I'm going to go over this relatively fast because we've done it, but $21, $22 is our resistance line. So until we cross 21.22 at this point, we are not in a bull trend for SoFi. We're still in a downtrend. So everyone hyping up the stock saying we're going all in SoFi is a little bit crazy because we're in a sideways market still. We're not quite there pumping yet. If you wanted to trade this, I would wait until 21.22 and then trade it when it's a clear breakout, right? Until then, you don't know what's going to happen. It might hit this 21.22 and just go right back into the range it was at between 15 and $18. So that's what I expect to happen. I hope I'm wrong because I do have a lot of shares. I hope I'm wrong, but if I'm not, then I'm willing to buy more shares at around 15, $16, maybe even $17. The last bit is the RSI actually did break out. So we might be heading higher, and that higher might be the 21.22. So if I was to like do a short-term trade SOFI might be looking a little bit bullish if it could hold this line. But as soon as it hits an RSI of around 90, even lower, I wouldn't even wait that long, but 88, let's say 88, then you should be really selling your trade. Like, for example, you can do a cash secured put where people pay you, and if it goes up to around $21, $22, you can sell that cash secured put for a bit of profit. And that's the way I've been trading SOFI. I have a small stack that I use for these covered calls and cash secured puts, which I've discussed in a previous video, and I'll link that as well. And you guys basically can do your own research on this, but I think we're still going to stay in this range unless we see some massive catalyst, like maybe the bank charter is the catalyst. I don't know. The last one we're going to discuss is Chargepoint. We really haven't covered Chargepoint too much. I think maybe we did a video a long time ago on it, but nothing recently. And there's a reason for it, because it's been on this massive downtrend and there's really no serious catalysts yet coming out for Chargepoint. Plus it doesn't make money. Plus the price to sales is like crazy. I'll show you real quick. Price to sales of this company is 16. So you're talking about a completely overvalued stock, even though it dropped by over 50%. So are we getting a good deal at 20 bucks? I don't think it's a good deal. I do like the company. I do like what they're doing. Market cap is getting to the point where it's becoming more attractive. So market cap of 6.43 billion. Short interest is 10%. I'm surprised it's not more because they're so unprofitable. And also because the price of sales is so crazy, I would think that this would be higher. We can look at iRobot like we did, which has a bigger short interest and makes more money than this company. So it's kind of funny. It hit a 52-week high of 50 bucks. So it's trading at the bottom of the range. And I still see there's possibility for downside. Doesn't mean there has to be, but there's definitely a possibility. Let's cover the chart real quick. We're on a downtrend again. All these stocks we're looking at are in a downtrend, and this is the good time to accumulate stocks. So anyone who wants these to be on an uptrend, you are not an investor. You're probably just trading and you're a speculator. So everything I'm talking about is actually a little bit longer term investing. So we're in a downtrend. Here we were at support at around $19.50. It broke down and recovered. So now we're sitting back on that support line. But if it can't hold it, I do see a possibility that we go into this window right here between 1450 and 1650. And there's a reason I say that. Back in the good old days of last year when the market was pumping, we did sit here for a while in this range where it sort of traded. And so that's, this stock doesn't have a long history. So this is the only real good level of support I could find, that if it's ever back in this range of 1450 to 1650, I would be a buyer again. But at these prices, I'm really not a buyer at 19, 20 bucks because it's under all the moving averages. Even if it pumps to $28, it still has to break it. I see no reason for this to be broken right now. There's a lot of catalysts we need. We need charge points to make more money. We need Chargepoint to build a better infrastructure. Besides these level 2 chargers that they're doing, they need to do better charging, like supercharging, right? And number 3, the infrastructure bill has to hit as well. So this might pump to 28 bucks when the bill hits. So this could be a good short-term play. But honestly, if I'm only in it for the short term, I'm not interested. In most stocks, I sort of would rather buy the companies we've already talked about, like Enphase, and just keep accumulating those. Okay, guys, thanks for watching. Remember, we're going to have that Neovolta interview coming up in a couple of weeks. So hit like and subscribe, hit the bell so you're notified when it drops. I've included our Twitter and email right below and right down here somewhere. So you can always hit us up, tweet us, and let us know what you want to see. All right, thanks a lot.